Welcome back to the channel. I'm Algabot, and I break down automated trading strategies for MetaTrader 5 in plain, everyday language. Today we're looking at an expert advisor called Momentum Glide Pullback. This is a trend continuation strategy that waits for an established trend, then looks for a shallow pause, and aims to rejoin the move as momentum turns back in the trend's direction. It blends two classic tools, a pair of moving averages and the relative strength index, with stops and targets scaled by the average true range. By the end, you'll understand exactly how it thinks. This is educational content only, not financial advice. Let's start with the big picture. Momentum Glide Pullback belongs to a family of strategies known as trend continuation or pullback riders. Instead of trying to catch a reversal at the very top or bottom of a move, this approach waits for a trend that is already underway, then looks to enter on a temporary dip inside that trend. The idea is to buy strength during an uptrend after a brief cooling off, and to do the mirror image during a downtrend. The strategy leans on two well-known building blocks. The first is a pair of exponential moving averages, a faster one and a slower one, which together define the direction and the health of the trend. The second is the relative strength index, or RSI, a momentum oscillator that measures whether recent price action has been leaning bullish or bearish. Rather than using RSI in the classic overbought and oversold way, this strategy watches how RSI behaves around its midline to time the moment a pullback ends and the trend resumes. Because every stop loss and take profit is measured in multiples of the average true range, the strategy naturally adapts to the volatility of whatever market you attach it to. On a calm, slow-moving pair, the stops and targets tighten. On a faster, more volatile instrument, they widen. That means you can attach it to foreign exchange pairs, metals, indices, or other symbols, and on whichever time frame you prefer, from intraday charts to higher time frames. Who is this style suited to, educationally speaking? It tends to appeal to traders who are comfortable following an existing trend rather than predicting turning points, and who like the discipline of a mechanical rule that only acts once specific conditions line up. It only ever holds one position at a time per magic number, so it stays selective. As always, remember that trading carries real risk. Losing trades are a normal part of any strategy, and nothing here is a promise of any particular outcome. Now let's walk through the logic step by step. Everything is evaluated on the most recently closed bar, so the strategy waits for a candle to finish before making any decision. That avoids reacting to noise inside an unfinished bar. First, the strategy defines the trend using two exponential moving averages. By default, the fast average uses 20 periods and the slow average uses 50. For an uptrend, the strategy needs the fast average to be above the slow average, and it also checks that the slow average itself is rising compared with 5 bars earlier. That slope check is important because it filters out flat, directionless markets where the averages have simply crossed without any real momentum behind them. For a downtrend, it needs the exact opposite, the fast average below the slow average, and the slow average falling. Second, inside a confirmed trend, the strategy waits for a shallow pullback. It measures this with RSI, using a period of 14. The midline sits at 50. In an uptrend, a healthy pullback pushes RSI down below 50 as price pauses. The strategy remembers this, then watches for RSI to cross back up through 50 as buyers step in again. That upward crossing is the signal that the pause is ending and the trend may resume. Third, there are two extra filters on that entry. RSI must still be below an exhaustion cap of 72, so the strategy avoids chasing a move that is already stretched. And the signal bar itself must be bullish, closing higher than it opened, and it must close back above the fast-moving average. When all of those conditions align, the strategy signals a long entry. The short side is a perfect mirror. In a confirmed downtrend, RSI must lift above the midline during the pullback, then cross back down through it, while staying above the mirrored floor of 28 on a bearish bar that closes below the fast average. Finally, risk management. Whenever a position opens, the stop loss is placed at 1.8 times the current ATR away from entry, and the take profit at 3 times ATR. That produces a reward-to-risk ratio of roughly 1.67 to 1 on every trade. The strategy only ever holds one position at a time for its magic number, so it never stacks trades. Remember, stops can and do get hit, and this is educational information, not advice. Let's read the actual meta-editor code on screen. At the top are the input parameters you can adjust in the strategy tester or on the chart. You can see the fast and slow EMA periods of 20 and 50, the slope lookback of 5 bars, the RSI period of 14, the RSI midline of 50, and the exhaustion cap of 72. Below those, the ATR period, the stop-loss multiplier of 1.8, the take-profit multiplier of 3, and the order volume. Just under the inputs, the code sets 2 flags for trend direction. Up is true when the fast EMA is above the slow EMA, and the slow EMA is higher than it was 5 bars ago. Down is the reverse. It also mirrors the RSI levels for shorts, flipping the midline and the cap around 50. Now look at the buy block. The long signal is true when the trend is up. The previous RSI was below the midline. The current RSI has crossed back up to or above it, but is still under the 72 cap. The bar is bullish, and it closed above the fast EMA. When that is true, the code reads the ask price, sets the stop loss at 1.8 ATR below it, and the take profit at 3 ATR above it, and calls trade.buy. The sell block is the mirror. The short signal needs a downtrend, RSI crossing back down through the mirrored midline while staying above the floor on a bearish bar that closed below the fast EMA. It then reads the bid, places the stop above and the target below, and calls trade.sell. Same structure, opposite direction. Let's bring the logic to life on this illustration. On the price chart, you can see 2 moving averages, the blue fast EMA hugging price closely and the gold slow EMA moving more smoothly underneath. Below the candles is the RSI subpanel, with the midline drawn at 50, the upper exhaustion cap at 72, and the mirrored lower cap at 28. Look at the first 2 candles. Price is climbing. The fast EMA is sitting above the slow EMA, and the slow EMA is gently rising. That combination tells the strategy and uptrend is in place. Over in the subpanel, RSI is comfortably above the midline, confirming that momentum is leaning bullish. Now watch the 3rd and 4th candles. Price pulls back, dipping lower for a couple of bars. This is the shallow pause the strategy is waiting for. As price cools, RSI slides down and crosses below the 50 midline. The strategy notes this, but it does nothing yet. It simply waits, because a pullback on its own is not an entry. The 5th candle on our chart, Index 4, is the one that completes the setup. It closes bullish, pushing back above the fast EMA, and at the same moment RSI crosses back up through the midline, while staying well below the 72 cap. Every condition lines up, so the buy entry marker appears. The strategy reads the ask price, places its stop just below entry at 1.8 times ATR, and sets the take profit target at 3 times ATR above. That's the reward to risk of roughly 1.67 to 1 we talked about. From there, price glides higher with the trend, exactly as the strategy's name suggests. The next several candles extend the move. The fast EMA leads price upward, and by the 8th candle price reaches the take profit target, where the long trade closes for a gain in this illustration. Now the market character changes. Momentum fades, price rolls over, and around the 9th and 10th candles the fast EMA crosses below the slow EMA, which itself turns down. The strategy now recognizes a downtrend. Watch RSI fall below the midline as selling takes over. Then comes the mirror image of our first trade. On the 11th and 12th candles, price pulls back upward, a shallow bounce against the new downtrend, and RSI lifts back above the 50 midline. That is the short side's pullback. On the 13th candle, Index 12, a bearish bar closes back below the fast EMA, and RSI crosses back down through the midline, staying above the 28 floor. The sell entry marker prints. This time the stop sits just above entry and the take profit target sits below, again measured in ATR multiples. Price then slides lower, candle after candle, riding the downtrend until it reaches the lower take profit target on the final candle. Notice the symmetry. A buy on a cooled pullback inside an uptrend, and a sell on a cooled bounce inside a downtrend, each confirmed by an RSI midline crossing and a candle reclaiming the fast EMA. That symmetry is the heart of Momentum Glide Pullback. Of course, not every setup runs cleanly to target like this idealized example. In real markets, the stop is sometimes reached first, which is why the risk controls matter. So that's Momentum Glide Pullback. We covered how it defines a trend using a fast and a slow moving average with a slope check, how it waits for a shallow pullback and uses an RSI midline crossing to time reentry with the trend, and how it caps that signal to avoid stretched moves. We also read the actual meta-editor code for both the buy and the sell side, and walked a long and a short trade candle by candle, with stops and targets scaled by ATR. Everything here is educational information only, not financial advice, and not a recommendation to trade any market. If you found this breakdown helpful, please like the video, subscribe for more MT5 strategy analyses, and leave a comment with the strategy you'd like me to cover next. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.